The gravity of money. Inside the anatomy of financial bubbles. In 1637, a single tulip bulb sold for more than a house in Amsterdam. Not a mansion, not a palace, a flower. Almost 400 years later, people would spend millions buying digital coins, meme stocks, and virtual images that existed only on screens. Different centuries, different technology, same human behavior. Every financial bubble in history follows the same pattern. Prices rise. Excitement spreads. Skeptics are mocked. Ordinary people rush in. Fortunes appear overnight. Then something changes. Buyers disappear. Fear replaces greed. And the collapse begins. The details change. Human nature does not. The story starts in the Netherlands during the Dutch Golden Age. Amsterdam had become the financial center of the world. Trade ships returned loaded with spices, silk, and wealth from across the globe. The Dutch were rich, confident, and building what looked like the future. Then came tulips. Originally imported from the Ottoman Empire, tulips became luxury status symbols among the wealthy. The rarest bulbs displayed strange streaks of color caused by a mosaic virus nobody understood at the time. Their imperfections made them more desirable. At first, collectors simply bought flowers. Then traders discovered something far more addictive: speculation. People began trading contracts instead of tulips themselves. Buyers purchased bulbs still buried underground, hoping to sell them later at higher prices. Prices rose faster and faster. Some bulbs doubled in value within days. Soon, nobody cared about gardening anymore. They cared about getting rich. People mortgaged homes, sold businesses, borrowed heavily. Taverns became unofficial trading floors filled with merchants betting fortunes on flowers they never intended to plant. Then one day in February 1637, at an auction in Haarlem, a buyer failed to appear. That single moment shattered the illusion. Suddenly, everyone remembered the same thing at once. It was just a flower. Prices collapsed almost instantly. Contracts became worthless. Lawsuits flooded Dutch courts. Fortunes vanished in weeks. And yet the real lesson was never learned. Because bubbles are not accidents. They are recurring expressions of human psychology. 80 years later, Britain repeated the cycle during the South Sea bubble. The South Sea Company promised enormous wealth from trade with South America. The reality hardly mattered. What mattered was the story. Investors believed Britain had discovered unlimited riches overseas. Even Isaac Newton got caught in the frenzy. At first, Newton invested early and made a profit. Then he watched prices continue climbing after he sold. Unable to tolerate missing out, he bought back in near the top. When the bubble collapsed, he lost a fortune. Later, Newton reportedly said, "I can calculate the motion of heavenly bodies, but not the madness of people." That sentence may be the most accurate description of financial bubbles ever written, because bubbles are never purely financial events. They are emotional events. Logic becomes weaker as prices rise. The higher prices go, the more people assume they must continue rising. Wealth appears effortless. Skeptics sound outdated. Caution becomes embarrassing. And every bubble creates its own language. In 1720, it was overseas trade. In the 1920s, it was industrial progress. In the 1990s, it was the internet. In the 2000s, it was housing. In the 2020s, it became crypto, meme stocks, NFTs, and artificial intelligence. The technology changes. The psychology stays identical. The 1929 stock market crash revealed how dangerous speculation becomes when ordinary people believe markets can only go up. During the Roaring '20s, America experienced explosive growth. Cars, radios, electricity, and modern factories transformed daily life. For the first time, millions of regular Americans entered the stock market, and many bought stocks using borrowed money. This was called buying on margin. With only a small deposit, investors controlled massive amounts of stock. As long as prices kept rising, profits multiplied quickly. But leverage works both ways. Once prices started falling, investors were forced to sell. That selling pushed prices lower, which triggered more forced selling. The system fed on itself. By the time the market bottomed in 1932, stocks had lost nearly 90% of their value. The Great Depression followed. Millions lost jobs. Banks failed. Families lost homes and savings. An entire generation learned that markets could destroy wealth far faster than they created it. For a while, fear replaced greed. But eventually, memories faded. They always do. By the late 1990s, the internet created another wave of financial euphoria. This time the excitement was real. The internet truly was revolutionary. But real innovation often becomes the fuel for irrational speculation. Companies with no profits suddenly became worth billions. Investors stopped asking whether businesses made money. Growth alone became enough. If a company added calm to its name, investors poured money into it. The Nasdaq soared. Young tech founders became overnight celebrities. Day trading exploded across America. And once again, warnings were ignored because prices kept rising. Then the buyers disappeared. The dot-com crash wiped out trillions of dollars. Hundreds of companies vanished. Many investors lost everything. But something important survived. The internet itself. That is what makes bubbles so dangerous and confusing. The underlying innovation is often real. Railroads changed transportation. The internet changed communication. Artificial intelligence may transform entire industries. The problem is not the technology. The problem is price. People stop investing rationally and begin paying any amount because they fear missing the future. That same psychology exploded again during the housing bubble of the 2000s. Banks handed out mortgages to people who could barely afford them. Those loans were bundled into financial products and sold around the world. Ratings agencies labeled risky investments as safe. Everyone collected fees while home prices climbed higher. The entire system depended on one assumption. Housing prices would never fall. But when prices stopped rising, the illusion collapsed. Mortgage defaults spread through the financial system. Major banks failed. Global markets crashed. Millions lost homes and retirement savings. The crisis exposed something uncomfortable about modern finance. Sometimes the people selling financial products do not fully understand them either. And yet bubbles continue because human beings are wired for them. Our brains evolved for survival, not financial markets. We follow crowds because crowds once kept us alive. We copy successful people because imitation helped our ancestors survive. We fear missing opportunities because scarcity once meant danger. Modern markets exploit those instincts constantly. Social media made the problem even worse. In previous generations, people compared themselves to neighbors. Today, they compare themselves to millions of strangers online. Every day brings new stories of overnight crypto millionaires, stock trading influencers, and viral investment trends. Fear of missing out spreads globally in seconds. And once enough people believe prices will keep rising forever, logic becomes irrelevant. The meme stock frenzy of 2021 proved this perfectly. GameStop, a struggling video game retailer, exploded from a few dollars per share to nearly 500. Online communities turned investing into entertainment. Stocks became memes. Trading apps looked like video games. Some people made fortunes. Many bought near the top and lost heavily after the collapse. But the frenzy revealed something deeper. Modern bubbles are no longer driven only by banks or Wall Street. Now they are amplified by algorithms, influencers, online communities, and viral emotion. Which brings us to cryptocurrency and artificial intelligence. Bitcoin has experienced multiple crashes exceeding 80%. Each time, critics declare it dead. Each time, new believers arrive. Crypto combines every ingredient necessary for a bubble: revolutionary technology, scarcity narratives, anti-establishment ideology, online tribalism, and dreams of instant wealth. And then came artificial intelligence. AI companies surged in value as investors rushed to buy the future. Some businesses added AI to marketing materials and watched their stock prices soar overnight. The pattern feels familiar because it is familiar. This does not mean AI is fake. It means real technologies can still become wildly overvalued. That has happened repeatedly throughout history. The railroad was real. The radio was real. The internet was real. And all of them experienced devastating bubbles before becoming permanent parts of society. The hardest truth about bubbles is that nobody believes they are inside one while it is happening. Every generation thinks it has discovered a new era, new rules, new economics. But history repeats because human behavior repeats. Greed repeats, fear repeats, envy repeats, hope repeats. And the four most dangerous words in finance continue echoing across centuries. This time is different. They were spoken during Tulip Mania. They were spoken before the Great Depression. They were spoken before the housing crash. And they are being spoken right now. So what can history actually teach us? Maybe not how to prevent bubbles, but perhaps how to survive them, because bubbles will never disappear completely. Markets are built from human emotions, and human emotions do not evolve as quickly as technology. The goal is not perfection. The goal is remembering. Remembering that fast money disappears quickly. Remembering that crowds are often wrong at extremes. Remembering that anything rising vertically can also collapse vertically. And remembering that patience has outlived every bubble in history. 400 years after Tulip Mania, the world has changed almost beyond recognition. We built skyscrapers, computers, artificial intelligence, global digital currencies. But underneath the technology, human nature remains almost untouched. We still chase easy wealth, we still fear being left behind, and we still forget the same lesson over and over again. Everything that rises eventually falls.